Today, we're focusing on a pretty interesting article. It tackles a very practical question for investors.
Right. It's about enhancing long-term returns using factor tilts, specifically size and value.
Yeah, the classic ones.
So picture this. You've got your main investment, say, a broad market fund, but you want a bit more juice from the size and value factors.
Because history suggests they might outperform long term.
Precisely. So the big question this article asks, and this is our mission for this deep dive, based just on this source, is it better to add one satellite fund that covers both small cap and value?
Or do you go for two separate funds, one for small cap, one for value, to cover that tilt?
We're going to unpack the strategies they looked at, the theory behind it all, and importantly, the potential downsides the article mentions.
Sounds good. It's a common dilemma.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
So before we tackle that one fund versus two problem, the article kind of sets the stage. What are factors in investing, according to this source?
Well, they define a factor pretty simply, actually. It's basically a characteristic, a trait of companies. Historically, firms at one end of that spectrum tend to do better than firms at the other end.
Okay, like sorting them based on a specific feature.
Exactly. And finding that, having that feature often correlates with better long-term returns.
Got it. And the two we're focused on today are size and value. How does the article define those?
Okay, so size is about market capitalization. The size factor is the observation, really, that smaller companies, small caps have, over the long haul, tended to outperform larger companies.
That's the size effect. Makes sense. And value?
Value is described as, cheap companies doing better than expensive ones, long term, again.
And cheap doesn't just mean a low stock price, right?
No, absolutely not. It's about the price relative to fundamentals. So the article mentions things like price-to-earnings ratios, book-to-market value, metrics like that. Companies trading at lower multiples are seen as value stocks.
And the expectation is they'll outperform eventually.
That's the historical evidence, yeah.
So for both size and value, the expectation of higher returns comes from looking back at the data. What else do they have in common based on this article?
Well, a really key point they stress is that this outperformance is a long-term expectation. It's definitely not a guarantee year to year.
Ah, okay. So patience is required.
Very much so. The article makes it clear these factors and the funds tracking them can go through really long stretches of underperformance. They even bring up Macquarie's work from 2025.
Oh, yeah. What's the point there?
Macquarie apparently highlights this difference between the statistical significance you might find in academic studies using long-short portfolios.
Right, the theoretical stuff.
And the actual experience of investors using the long-only funds you can actually buy. Those long-only funds can lag for a very long time, even if the underlying factor works over decades in theory.
That's a crucial distinction for practical investing, so you really need that long horizon.
You absolutely do. The article implies patience isn't just nice to have, it's essential.
What about the why? Does the article touch on theories for why these factors might even exist?
It does, briefly. It mentions the two main camps, really. One is risk-based. The idea that maybe small or value stocks are inherently riskier in ways standard models don't fully capture.
So you get paid more for taking on that hidden risk.
In theory, yes, if markets are efficient. The other camp is more behavioral. It suggests maybe investors make mistakes, biases lead them to misprice these stocks temporarily.
Preventing opportunities.
Exactly, opportunities that eventually correct, leading to outperformance for those who bought when they were cheap or small and overlooked.
And they give a nod to the academic history. Basu, Bands, Fama French.
Yeah, they mentioned Basu on value back in 77, Bands on size in 81, and of course Fama and French, adding these to the capital asset pricing model, which kind of kicked off the whole factor investing boom.
Leading to the factor zoo, as some call it.
Yeah, that term gets thrown around. So many factors identified since then.
Okay, so we've got the basics. What size and value factors are, the long-term view needed, some theory. Let's get back to that core strategic question the article tackles.
Right, so the setup is, An investor already has, say, 60% of their portfolio in the broad stock market. That's the core.
And they want to dedicate the other 40% to tilting towards size and value, hoping for better long-term returns.
Yep, that's the scenario they analyze.
And the big choice for that 40% is?
Option 1, put the whole 40% into a single fund designed to capture both small cap and value characteristics. A dedicated small value fund.
Okay, the all-in-one approach.
Or option 2, split that 40% between two separate funds, maybe one purely small cap index fund and one purely value index fund.
The mix and match approach.
Now, intuitively, splitting it feels like you have more control, maybe. You could decide, I want a bit more small cap exposure than value, or vice versa.
That's definitely a potential advantage. The article notes the customization you get with two funds. And the single fund is simpler, clearly.
But the real question the article digs into is, which way actually performed better? And maybe more importantly, why?
Precisely. It's not just about ease or control, it's about the results.
So how did they test this? What data did they use?
They looked at it through two lenses. First, a really long historical perspective using the academic Fama French factor data.
Going way back.
Yeah. July 1926 through December 2024. That gives you almost a century of data, avoiding issues like specific fund availability or fees early on.
But it's theoretical data. So they also looked
But
at
real-world funds, they used iShares ETFs that track small cap, value, and small value indices, looking at the period from August 2000 to December 2024.
So a shorter period, but using actual investment products that include costs and tracking differences.
Exactly. It's a good reality check.
And what specific portfolio setups did they compare within these data sets?
Okay, so for the one satellite strategy, it was always 60% broad market, 40% small value fund proxy. Simple enough.
Right.
For the two satellite strategy, it was 60% broad market, and then that remaining 40% was split between a small cap fund and a value fund. And they tested 5 different ways to split that 40%.
Oh, they varied the mix.
Yeah, they looked at 20% small, 80% value, then 40-60, 50-50, 60-40, and finally 80% small, 20% value for that 40% satellite allocation.
Covering a range of possibilities. Okay, let's get to the results. What did these super long-term Fama French data show? Which strategy won on returns?
Over that very long run, the one satellite strategy, the 60-40 with a single small value fund, had a higher average return. It came in at 12.1% per year.
And the two satellite strategies?
They ranged from 11.3% to 11.6%, depending on the small value split. So the single fund beat all the two fund combos.
By how much?
By about 58 to 88 basis points per year. Which sounds small, but
Over almost 100 years, that compounds massively.
hugely. The article puts numbers on it. A hypothetical $100 grew to over $7.9 million with that single small value fund approach.
Wow. And the best of the two fund strategies.
The best two fund mix only grew to about $4.76 million. So the single fund ended up with like 66% more wealth. It's a staggering difference over that time frame.
Okay, that's a pretty strong vote for the one fund approach based on raw returns. What about risk, volatility?
The one satellite strategy did have slightly higher volatility. Its standard deviation was 21.7% versus around 20.8% for the two satellite options. A bit bumpier.
But did the higher return make up for it? What about risk-adjusted return, like the Sharpe ratio?
Generally, yes. The article reports that the one satellite strategy typically had a higher Sharpe ratio. And importantly, in this long sample, that higher Sharpe ratio was statistically significant compared to most of the two fund mixes.
Meaning it's unlikely the better risk-adjusted performance was just luck.
Exactly. The long-term evidence strongly favored the single fund on both return and risk-adjusted return.
Okay, that's the academic data. Did this advantage hold up when they looked at the more recent period using actual iShares ETFs? The real-world check.
Well, the overall trend was pretty similar, actually. The one satellite strategy again delivered the highest return.
Where were the numbers there?
It averaged 8.8% per year in the iShares sample, compared to a range of 8.2% to 8.5% for the two satellite strategies.
So still outperforming, but maybe by a smaller margin.
Yeah, the outperformance was between 23 and 54 basis points per year. Still meaningful, but less dramatic than the 100-year number.
In volatility, was the single fund still slightly riskier?
Yes, same pattern. Volatility was 16.6% for the one satellite versus 15.3% to 16.1% for the two satellite options.
What about the Sharpe ratio in this shorter real-world sample?
The one satellite strategy still had a slightly higher Sharpe ratio, but the difference was small enough that the article notes it was not statistically significant in this case.
Ah, okay. So maybe not definitively better on a risk-adjusted basis in the recent past, but still directionally higher.
Right. And in terms of how much your money grew,
Did the one fund still win?
it did. $100 grew to $778 with the one satellite strategy, compared to a range of $688 to $738 for the two satellite options. So between 5% and 13% more wealth over that roughly 24-year period.
Still better, even if the statistical significance on risk-adjusted returns wasn't there in the shorter period. Now, the article also compared the Fama French results directly to the iShares results over the same recent period, right? Why do that?
Yeah, that's Exhibit 3 in the source. It helps isolate whether the differences we see are just because one data set is super long and the other is shorter, or if there's something fundamentally different between the academic factors and the real ETFs.
And what did that comparison show?
Over that shared period, the Fama French data did show slightly higher returns and also slightly higher volatility than the iShares ETFs. But the risk-adjusted returns ended up being pretty similar between the two types of data.
Okay, but for our main question, one fund versus two, what was the takeaway from that Exhibit 3 comparison?
The really crucial finding was that regardless of which data set you looked at, the theoretical Fama French data or the real-world iShares ETFs, when you compared them over that same recent period, the one satellite strategy consistently beat all the two satellite combinations on return.
So even in the recent past, using other data source, the single fund approach came out ahead on performance.
Yes, with similar volatility and, comparable or slightly better risk-adjusted returns, even if not always statistically significant in the shorter ETF sample.
Okay, the performance evidence seems pretty consistent then. The single small value fund strategy just delivered better results according to this article's analysis. But why? What's the mechanism?
Right, that's the next logical question. And the article digs into that using factor regression analysis, basically trying to measure how much exposure each strategy actually gave you to the size and value factors.
So looking under the hood at the factor ingredients.
Exactly. They used the standard three-factor model looking at sensitivity to the overall market beta, the size factor, SMB small minus big, and the value factor, HML high minus low.
And what did they find about the SMB and HML exposures?
They looked at the betas, the coefficients from the regression. A higher SMB beta means more tilt to small caps. A higher HML beta means more tilt to value.
And the key finding was?
The key finding, and this seems to be the core explanation, was that the one satellite strategy, the 60-40, with the single small value fund, consistently showed a larger combined exposure to size and value.
Combined exposure, meaning adding the SMB beta and the HML beta together.
Precisely. They summed those two betas, and that sum was consistently higher for the one satellite strategy than for any of the 5 two-satellite strategies they tested.
Do you have the numbers on that from the article? How much higher was the combined exposure?
Yeah, it's quite striking. In the long Fama French sample, the combined SMB plus HML beta for the one satellite strategy was 0.72.
Okay. And for the two satellite mixes?
They were all clustered really close together, ranging only from 0.51 to 0.52. So a big gap there, 0.72 versus around 0.51.
Wow. Yeah, and did that hold up in the iShares ETF data too?
It did. Same pattern, though the absolute numbers were lower overall, which you might expect with real funds. The one satellite strategy had a combined beta of 0.48.
And the two satellite strategies in the ETF data?
Much lower. They ranged from just 0.12 up to 0.32. Again, the single fund delivered significantly more combined factor exposure.
So the takeaway explanation is that the single small value fund, at least the one used as a proxy here, simply packs a bigger punch. It delivers more of the desired factor tilt per dollar invested compared to trying to build it yourself by combining separate small and value funds.
That seems to be exactly what the article concludes. If you believe size and value factors offer a long-term premium, then getting more exposure to them is likely better. And this analysis suggests the single fund was a more efficient way to achieve that higher combined exposure.
Which then translated into those better performance numbers we saw earlier.
That's the logical connection the article makes, yes. Higher exposure to rewarded factors leads to higher returns over time.
Okay, let's try and sum this up. Based on this deep dive into the article, the evidence presented strongly suggests that if your goal is to tilt a core portfolio toward size and value factors,
then using one dedicated small value fund for your satellite allocation seems to be more effective than splitting that allocation between separate small cap and value funds.
right, more effective in terms of getting higher combined factor exposure and ultimately achieving better long-term returns based on the period studied.
That's the main thrust of the findings, yeah. Covers both the long academic view and the more recent real-world fund view.
But like any strategy, it's not all sunshine and roses. The article does point out some important caveats or potential downsides, right?
Absolutely. And we touched on maybe the biggest one earlier, the time horizon. Factor investing isn't a short-term game.
You need to be prepared for potentially long periods of underperformance.
Exactly. The article, and that reference to Macquarie, really hammers home that you could be waiting years, maybe even a decade or more, for these factors to deliver relative outperformance. You need the discipline to stick with it.
Okay, what else? We saw the risk numbers.
Right. The data consistently showed the one satellite strategy, while delivering higher returns, also came with slightly higher volatility, slightly bigger ups and downs, compared to the specific two satellite blends they looked at.
So there's that classic risk-return trade-off. Higher potential reward came with slightly higher measured risk here.
Seems so, yeah. You have to be comfortable with that potentially bumpier ride.
And the final point relates back to that idea of control we mentioned earlier.
Exactly. The potential upside of the two-fund approach was customization. The flip side is, with the one-fund approach, you lose that. Meaning you're stuck with whatever blend of small cap versus value exposure that a particular small value fund gives you. You can't decide, I want a 70-30 split tilted more towards value this year. You just get the fund's predefined exposure.
So you trade customization for simplicity, and according to this study, potentially better results and higher factor exposure.
That's the trade-off, precisely. If fine-tuning that relative size versus value exposure is really important to you, the single fund doesn't allow for it.
Okay, so recapping the recap. This deep dive into the source suggests a single small value satellite fund looks like a more potent way to get size and value exposure compared to splitting between two funds.
Leading to better returns historically in their analysis, mainly because it delivered a higher dose of the desired factor tilts.
But it comes with slightly higher volatility and gives up that ability to customize the exact mix of small versus value.
It provides a really interesting empirical look at how these different implementation choices play out. Useful stuff for anyone considering factor tilts.
So for you, the listener, what's the final thought? The article makes a compelling case based on its data that one fund beats two for getting that combined size-value exposure and subsequent results. It seems simpler and more effective in their analysis.
Which kind of makes you wonder, how exactly are these factors bundled in funds? And how much does that higher factor exposure really matter to you compared to maybe wanting the control offered by two funds, even if the historical performance wasn't quite as good in this particular study?
It definitely gives you something to think about when deciding how you want to structure your own approach to factor investing. Lots to consider there.